Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey, everybody. Welcome back to the Working Wealth Podcast. My name is Patrick.
And I'm Haley.
And today we're going to continue our short series on hacking Social Security.
But not hacking into Social Security.
That's right, because we don't want anybody to go to jail if they don't need to.
God, you're so weird.
I know. It's fine. Today, what we're going to talk about specifically is one of the 4 benefits we discussed in our first episode where we broke down just high level, some history and very big sweeping general overview of Social Security system and administration. We're going to talk about retirement benefits today. So,
that's the only one I could think of last time when you asked me, what do you think of when you think of Social Security? And I was like, retirement benefits.
Yes.
And I totally let you down on the other 4 or 5 options.
Oh, it's okay.
Sorry.
It's okay. No worries. No worries. Most people don't know what all the different things are, so it's not a big deal.
All right.
So,
but this one will affect everybody-ish.
Yeah, it should.
Right?
Yeah.
In their life.
For the most part, I would say
For
it
the most
does.
part. I'm not an advisor.
Compliance. Anyway, before we dive in, though, let's just take a quick second and just say thank you for everyone who is listening, for tuning into the show, helping us, get the reach out. Really appreciate that.
I'm just laughing. And we really hope the people that are watching are more than just our moms.
Yes, that would be great. Please. But anyway, no, seriously, thank you so much for listening. Please feel free to share with anybody and leave a review because reviews definitely help us feel good about ourselves and
That's
boost
right.
our ego. We're not doing enough that it's really going to help the algorithm, so let's just make us feel good. That'd be fantastic. But anyway, jumping into retirement benefits. So very quick refresher, the 4 key benefits that are addressed with Social Security is retirement benefits, disability benefits, survivor benefits, and supplemental security income.
I'm really glad you just said them. That was really dangerously close to you asking me to say them.
Which is great because we just recorded that like 30 minutes ago, honestly. But anyway, so let's jump into...
No, I wore this shirt again today.
That's right. Yes, we actually record every episode on different days at different times because...
That's not true.
Yeah, anyway. So talking about retirement benefits, this is relevant. And I think you asked a really good question in the last episode around when should I start thinking about this stuff? And it is relevant for everyone, right? Whatever generation you're part of. If you are, a few years out from retirement, if you're in retirement today, if you're just starting your working career, there's a lot of confusion and questions around what is Social Security? When's it going to be there? Will it be there? A lot of these kind of questions. And I think that understanding some of the basics can help us alleviate some of the questions and concerns and maybe help us be more proactive in planning about the future.
Okay.
So jumping into the retirement benefits. So a couple things I want to make sure we touch on. We kind of alluded to last time, but just kind of reemphasize here is your retirement benefits are calculated based off of your highest 35 years of indexed earnings reported to the Social Security Administration.
I feel like that's a long time.
A long time? You mean like the 35 years?
Yeah.
Yeah, it is, right? And
I currently haven't lived 35 years.
Wow, I had not thought about that.
And I'm thinking that seems like a long time of working.
Right, which is why we focus with our business is helping people balance what it's like to live today while building and preserving generational wealth.
That's right.
Because the normal retirement system for today's generations is kind of broken, and we need to make sure that we're not retiring from something but to something when we transition from
I
work.
will worry about getting the highest 35 after I eclipse 35
years of age.
Yes.
Okay, gotcha. Well, if you wait until too long, though, that means you start at 35. Now you have 70 years of being on the earth before you.
That's the problem.
So let's just focus on increasing our income.
But now everyone's going to remember 35
you're not
years.
35 years
and that
old.
I'm not 35 years old. Yes.
All right. So anyway, going back real quick. So when you think about how your earnings are calculated or how your monthly benefit will be calculated from the Social Security system, it is based off your highest 35 years. There's a formula they use with how much money you pay in the system based on the payroll tax that's assessed for your income each year.
Okay.
That amount of money gets indexed based on inflation. Index just meaning it's adjusted based on inflation and cost of living changes over time to bring it up to whatever the quote current year benefit would be. Those numbers generate what's called a primary insurance amount. Your primary insurance amount is the monthly benefit you would receive at your full retirement age or normal retirement age. Full retirement age.
I was going to say, what is that?
Great question. So that is the age at which you get your full primary insurance amount.
So you choose it.
No, not necessarily. So
Okay, well, that was. It sounds very. I don't know.
Circular.
Yeah.
Yeah, it is one of those things.
Okay.
But yeah, so no, your full retirement age, right? So it's based off of the year you were born, and there's a table you can pull up.
Okay.
Essentially, just like high level for most people listening to this, if you have not filed for Social Security, you're not eligible yet, which we'll talk about. More than likely, your full retirement age is going to be 67 years old.
What's my full retirement age?
67 years old.
Okay, thank you.
Yeah. So if you were born in 1960 or later, your full retirement age is 67. If you were born in 1959, it was 66 years old and 10 months. If you're born in 58, 66 and 8 months, so on and so forth, to where if you were born between 1943 and 54, your full retirement age was 66
Why was it so specific for those years? And then they just decided, 1960 and everybody else, 67 years old.
That's a good question. And this is your reminder to write your congressman to always understand why laws are passed and what goes into these massive bills.
That's confusing.
Yeah. No, it really is, right? And the last big change around this was done back in, I believe, the early 90s, early to mid 90s.
So they've just decided, let's just make it 67 and move on.
Correct. Yeah.
Why are we voting on this every year? I don't know.
That's
me as Congressman Haley.
I don't think it's getting voted on every year. But you have a good point, right? So like this is a system that was last like overhauled 30 years ago, right?
And we're still just kind of chugging along with that.
We are, which there's, oh man, now we're bringing up some topics.
I don't mean to be doing that.
Okay.
I apologize.
But realistically, if you think about this, the last time it was really overhauled was about 30 years ago. And with that,
we don't have to understand the rules or the why to play the game.
We don't, but we need to understand the implications of that going forward, right? And this is where it's relevant for earlier or like newer generations. Is a lot of legislation that has been passed in the past 5 years, as well as is on the docket to be passed in the next few years, is changing the way retirement is prepared for going forward. Like even in the past 1 year, a lot of states, based on proposed federal legislation, have mandated businesses with so many employees or more to require retirement plans being offered for their employees. We have that with clients in Maine. We have that with clients in Colorado, other states out west, where they are being forced by law now as small business owners to set up retirement plans because of, going back to the why, how much pressure there is on these entitlement programs like Social Security. We'll come back to that in the future. So the gist is your full retirement age, if you're born in 1960 or later, is age 67, right?
All right.
Now, what that means is your full retirement age is actually the age at which you can get that primary insurance amount. So let's say your primary insurance amount was going to be—
Which is what again?
That is the target maximum benefit at retirement that you would receive from the Social Security system based on your highest 35 years of earnings reported into the system.
Why do I feel like there's not a simple answer here? But okay.
Yeah. Well, it's kind of like a pension, right? It's, you work and money gets paid in the system, and then based on, your age when you retire, you would get a fixed amount of money for the rest of your life, right? That kind of thing.
Keep going. You're doing great.
Thank you.
You're welcome.
You're making it hard on me today.
I'm sorry.
So the key thing about that, though, right, is the full retirement age is the age at which they're saying, hey, like if you wait to claim benefits on this date or like at this age, this is how much you're going to receive. But that's not when you have to wait to receive benefits. You can claim your benefits as early as age 62, or you can wait until as late as age 67. Now, the difference there is for every year, really every month you
We
claim benefits.
cannot wait later than 67.
Why is that?
No, I'm asking you.
Oh, no, you can. Yeah. I just said we can, right? So you can claim it as early as 62, or you can wait as long as age 70 to claim your benefits. But here's the difference. There's pros and cons to each. Your face looks so distraught right now.
I'm just trying to understand. I know because the amount changes.
Because the amount changes. Exactly. So like your primary insurance amount, that's how much you get at your quote full age. If you decide to claim benefits before that, you're going to have a permanent reduction on how much money you're going to receive on a monthly basis.
Forever.
Permanent. That's what that means.
It doesn't change.
It'll go up based on the standard cost of living adjustment every year.
Okay.
So like that's based on inflation. So we had 2 years ago, inflation was through the roof. It was like 9%. Everyone got about a 9% increase on their benefits.
Okay.
Average inflation being 2.5 to 3.5 is the target. You get a bump of that much percentage every single year.
All right.
But it's based on the actual inflation every year. The key thing though is like if you claim early, you do get that permanent reduction. So based on those who are born in 1960 or later with a full retirement age of 67, if you claim it as early as possible, you're going to have a 30% reduction of your primary insurance amount. So easy math, right? Let's say your primary insurance amount would be $3,000 a month at age 67. If you claimed at 62, you would actually be receiving $2,100 because it's a 30% reduction on what that total amount would be.
Forever,
with the exception
not accounting inflation.
Not accounting for the inflationary increases.
Okay.
Exactly. Right. So this becomes a really, really important question in terms of retirement planning.
So this becomes a big math problem.
It does. Yeah.
How early do I have to take it because of lack of planning? Or how late can I wait because I did plan?
Exactly.
Right? I mean, just as bluntly as that.
Yeah. And it's not just like, so that's the key thing is like, what are my cash flow needs, right? But there's also a side that we talk about.
There again, cash flow. Hashtag live on a budget.
There you go.
I don't know. I'm in rare form right now.
You really are. It's great. I love it. But so the key thing is it's not, so the number one thing we think about or we talk about with clients is obviously, well, what is our need? Right? Like, because if you have not planned as well, or if life has been such that you haven't planned as well,
right.
You don't have as much resources, because we know there's a lot of reasons for that. If you don't have as much to support yourself, your income needs outside of Social Security, a lot of times we do need to claim it early because we don't have another option, right? But on the flip side,
which is great that there's the option there if you need it.
Correct. Yeah. But on the flip side, there's also the case where we have a lot of clients that have done really well and they've planned very well. Mm-hmm. And it becomes more of a decision around, hey, like we can claim this earlier, maybe before our full retirement age and start getting those benefits and save drawing from our portfolio. And like, let's do some strategic tax planning around Roth conversions or, helping to avoid Medicare surcharge taxes or doing charitable giving, like things like that. So there's
leaving the money in.
Leaving the money in gross, right?
A couple of years, big difference.
It's a lot better, right? Yeah.
So you have the options.
Correct.
That's kind of cool.
Yeah.
I wouldn't have thought about that first off.
Right. So having the option of flexibility is the most important thing.
Right.
There are a lot of considerations there, though. Like I don't want to just gloss over that too much because, the biggest factor that nobody can really control technically is how long you're going to live. So a lot of times when we talk with folks that are transitioning into retirement, they say, well, should I take it early? Should I take it later? I'm like, when do you want to die? Right? All the numbers, all the calculations are based off of, expected life expectancy. Right? So there's a break-even point for almost every case study between age 78 and like 82 that if you live past that time frame, you'll benefit more by deferring, like claiming your benefits later.
Okay.
But who knows when something's going to happen,
well, no
right?
one has the crystal ball.
Right. And a lot of folks that we talk with or we meet with it's more so, hey, I've been paying into this for 40 years. Let me just go and get some money out of this, right? And if it gives us more investment or portfolio stability, we can let our assets grow or use that for more fun things in life, then it might make more sense to do that, right? But every person is different, and I've advised clients differently based on their personal desires and circumstances. The key thing, though, going back to like when you claim, is you can claim as early as 62.
Okay.
But if you wait until after your full retirement age, you actually get an increase on your benefit all the way up until age 70.
Okay, that was going to be my question.
Yeah. So for every year you defer past your full retirement age, you get an 8% increase on your benefit. So if you wait, like say for us, it's 67 is full retirement age. If we wait until age 68, we'd get 108% of our original primary insurance amount. If we wait until, age 69, we get another 8% bump.
Are there
so on and so forth.
restrictions of what you can do with the Social Security income?
No, that's a very good question.
I was just
It's a very good question. Yeah, you can use it for anything. If you want to use it to reinvest, we have clients that do that.
I was wondering that very specific question.
Yeah, so we do have a lot of clients that are, they're full retirement age, and they are still working, part-time or full-time, and they just want to claim the benefits to reinvest or
If you are receiving Social Security benefits and you are working, is there a certain amount of numbers or a threshold of income that you can't make over to continue to receive that full Social Security benefit?
Yes. Yeah, that's a very good question. You reading ahead?
No, that was a question that just came up.
No, that is one of the things I want to talk about. So if you are working while receiving benefits, so this is where that full retirement age comes in really importantly.
Yes, I do think I know someone doing this. That's why this came to my mind.
So if you're full retirement age and you start receiving benefits, there is no reduction to your Social Security benefits on an annual basis. If you are before full retirement age, still working and receiving benefits, there's a certain amount of income you cannot make above before your benefits get reduced. So let's say you're under full retirement age, or you're you are before the year in which you would turn full retirement age, right? You have a deduction of $1 for every $2 earned above the earnings limit.
Okay.
The earnings limit, it's based on each individual person. It's not based on like household income. So for each individual person, it's currently is going to be $1,860 per month, or $22,320 for the year is how much you have to stay below before your benefits would get reduced if you claim before full retirement age.
Yes. Got it.
Yeah. Now, as soon as you reach full retirement age, though, you can claim your benefit and keep working, make $200,000 a year, and your benefits are not reduced, which is a nice way to kind of double dip, right? And have more opportunity to stack that money away, reinvest it, give it, et cetera, things like that. But there's additional rules, like in the year you turn your full retirement age, technically there's a deduction based on an earnings limit that's much higher, but there's also a special exception rule where that year you turn full retirement age, they just kind of ignore the limit and allow you, like, let's say you earned all that money for the entire 11 months out of the year. Okay. You made $100,000, and then you claim your benefits for the last year of that year. You don't actually have a reduction on your benefit. So they give you kind of a gimme the year you claim your benefits.
Okay.
Yeah.
Okay. No, I didn't read ahead. I'm sorry.
Yeah. No, you're good. That's great. I'm glad you asked the question. A very common question that comes up when we talk about Social Security is taxation. And I think this is one that a lot of people, without understanding how it works, have some assumptions that maybe cause them to delay benefits where they don't need to.
Is it taxed differently?
It is taxed a little bit differently.
Okay, tell us.
So you still have to pay federal income taxes and potentially state income taxes on the benefits you receive.
Okay, so you got a paycheck, you were taxed, your money went into the system.
Are we going to go here?
Then you receive your benefit, and then it's taxed again.
Yes, but it is taxed differently.
Snip, snip, snip.
Yeah, so this is okay.
My job is to make an office reference in every episode.
So have we done the bankruptcy reference yet?
No. Okay, I'm waiting for that one
for
yet.
A future one. But yeah, so here's the thing about that.
No, I mean, that's very interesting. Okay, so I mean, we don't have to get into that by any means, and that's not. It's just kind of like a ha-ha.
Yeah,
got us again.
Right.
So
fundamentally, because we won't get into like the right and wrong and morality of income taxes.
It's just sort of like, here, take this. Okay, I'll take that. Okay, but give it back. Okay, but
right. So going back to like where Social Security gets its funding is from specifically the payroll tax. Right?
Understood.
You are not charged a payroll tax
on your
Social Security benefits.
That makes sense.
Only federal and state taxes if you live in a state where state taxes apply.
All right.
Correct. Yeah.
All right. I take it back.
So it makes it a little bit easier to
I take it back.
Swallow
I'm
there.
just here for laughs.
Right. But I do want to point that out because that's a common question or common frustration we
Okay.
hear is like, around taxation of government benefits.
Well,
we can also
we'll
take
leave
this
that
whole
right
student loan
there.
discussion if we want to, because
Yeah.
that's a whole thing about that. But in general, so taxation, let's get back on point, right?
Yeah.
Taxation of Social Security benefits. Your taxation of your benefits has 3 different layers, right?
Okay.
And it's all based on how much money you earn while you're receiving benefits. You can, depending on your income, pay taxes on none of your Social Security benefits.
What?
It's like, so the first portion of your benefits could be tax-free, okay? The next level is, depending on your income, you might be taxed on half of your benefit. The third layer, which is the highest amount, is you could be taxed on up to 85% of your benefits. Let me clarify that.
In these moments, I get really glad that I married you.
Are we going to reference episode 3 now?
No.
Okay. So the key thing, right, is I want to clarify this. This does not mean you have a 0% tax rate. It does not mean you have a 50% tax rate. And it does not mean you have an 85% tax rate. It means the amount of benefits you are taxed on could be none of it, half of it, or up to 85% of the benefit. Does that make sense? Call us if you have questions.
I want to tell you yes.
I
I want to tell you yes, but I think it's a no. It doesn't make sense to me right now.
So let's say you have $40,000 in Social Security benefits.
Okay. I have it. Yes.
You could be taxed on none of that, half of it, or 85%
I get
of it.
the principle of there's 3 options of taxation.
Okay.
But I want to know why there's 3 options and what qualifies me for the 3 options.
This is your second reminder to call your congressman and be active in the voting process in our country.
Okay, seriously, what is it?
So the thing that determines how much you are taxed, right, is based on a concept called your provisional income. All that means is take your gross income, add in non-taxable interest, and half of what your Social Security benefits are. And if you fall in a certain range, that determines how much of your benefits are taxed. It's a threshold. It's a threshold. Yeah, it's a threshold.
So if I make a lot of money, am I paying a lot of tax?
You're going to be if you're making above that threshold, you're going to pay taxes on 85% of your benefits.
What's the threshold I'd have to be above?
So if you're married filing jointly and your provisional income is over $44,000 for the year, right? You're going to have 85% of your benefit taxed.
I mean, I feel like a lot of people I know make over $44,000 a year and are married filing jointly.
Well, and I would hope in retirement you are bringing in that much money, right?
Okay.
But there's a lot of things we can do, and this goes back to like the pre-planning from an early age is the more money you have that's tax-free down the road, the more benefit you have to reduce your lifetime tax liabilities. So that's the whole Roth pre-tax discussion around retirement accounts. That's do I invest in things?
I have so many questions that we cannot ask on this because it's just going to get laborious.
Well, give us one just for the people.
So now I'm sitting here thinking, okay, let's say I am retired. And so this has to do with how much money we are drawing also out of retirement to know how we couple that with the Social Security benefit, to know what threshold of taxation on that income we're going to hit.
Yeah.
This is a lot.
Yeah.
Okay.
So when you think that financial planning is easy and you don't want to pay a competent advisor, remember this conversation.
Yikes. Okay.
Right? Yeah. No,
okay,
it's a real thing.
Though.
Yeah.
Okay. Real question.
Yeah.
For me, who's literally just figuring this out while we're on this recording, like,
it's raw.
How do people navigate this legitimately in life?
Yeah,
and my question is, do the masses know that there are 3 different taxation rates? God, you just hit the
Just keep hitting the table. I'm sorry.
Let's
be raw. Let's be raw.
Do people know this?
Where's a cigar? Let me get a cigar right now.
Do people know this?
Yeah, I don't think they do.
I don't think they know either.
Yeah, and let me do this. So
you messing everybody up.
Everybody up. No, it's so this is why it's so important to be proactive with your financial life, right? But you're exactly right. Like, so most people, like, tax planning is not a thing. It's, oh, hey, I got a refund, or, oh man, I owe $3,000.
Oh, hey, I overpaid the government. Now I'm going to go buy something.
Right. Yeah.
Sorry.
So it's,
Not
or
sorry.
if you're a business owner and it's, oh, I need to spend money on something so I can get a write off. Well, how about you just like open a 401k plan, get tax credits to make it 100% free to open to start with under current law, and defer $70,000 into it this year to save on your taxes instead of buying a truck for your business.
And I apologize
It's,
that I've taken us down this rabbit hole, but I just think
it's okay.
sometimes
This is more fun.
it can be, it's, I don't know. It's just sometimes really hard to think about. I know that the majority of people, like, this is a great program. Yeah, Social Security benefit. But it's like we've made it so convoluted and it's got so much red tape that, like, educated people who are smart don't know what's going on.
Mm-hmm.
Because who's going to dedicate the time to this? You are. You are. You weirdo. You are. That's just great, which is great. But, like, I mean, like, it's just, I just think of all the, I just think, man,
Yeah.
there's so much value here to help people.
Right.
Because people are not expected to know all this on their own.
Right.
So that it's like cool that we have the opportunity to help people, but it is also kind of like, man, they make it really tough on the average person.
Mm-hmm.
Which kind of stinks. All right. Now I'm done playing my little violin, feeling bad about it.
Okay, good.
Go back to this. It's just, that's just kind of like, holy cow, there's so much there. It's not like, it's not just picking an age to retire and starting to pull money.
And we'll have a whole nother episode or two about like how you pull money out of investments, right? Because even that, you know, a lot of people tout like the 4% rule, or they, you know, or mistakenly think you just pull everything out of investment accounts, put it in the bank. That's the wrong answer, my opinion. Don't take that as specific advice, right? You know, we'll talk about it one-on-one. But yeah, no, there's so much that goes into this that it's not just an easy peasy. And I have that conversation with people regularly where they say, oh, well, you know, I don't want to pay the fee, or, oh, I don't, you know, I can do this on my own. That's great, but call us when you have a problem, because it's not just when you have big problems. It's, you know, when you're young, how do I balance cash flow of like buying a house, or what bills I should pay, or how do I pay off debt so I can then have margin to build wealth, right? How do I navigate college funding? How do I, you know, decide if I should buy an investment property, or if I should, you know, change jobs and move halfway across the country for better income? You know, a lot of conversations we have with folks is around those finer things that a lot of people just kind of flounder through or make a whim decision that could hurt them in the short term, or not understanding how the details work together, where they could make a better decision that, even if it's a pay cut in the short term, on the surface, could actually be a pay raise in the long term. There's a lot of things around this that are important that, yeah, you're exactly right. We should definitely be intentional and proactive. This is why I get so passionate about it, right?
Yeah.
So when I have conversations with people that I'm just like, they're just not getting it, right?
But also sometimes it's a good
because,
reminder of why we do what we do.
Correct. Yeah.
Yeah. Interesting.
It is. Yeah.
Okay.
So back to Social Security, though.
Right.
So long and short of it is,
count on Haley to make Social Security fun.
There you go. Depending on how much money you make as you're drawing benefits will affect how much that benefit is taxed.
Right. That makes
sense. If you want to talk about like the taxed on what you're taxed on kind of thing, in reality, the most you're going to be taxed on it is 85% of your benefit is taxed. Which, if you think about it fundamentally, going back to the conversation about payroll taxes before, you know, your combined payroll taxes is about 15% of your total income. You're kind of getting that gimme back because you're not paying those taxes again.
Okay.
Right?
Understood.
But thinking about that, you know, in summary, again, you can claim as early as 62. You can defer until 70. You get a permanent reduction if you claim before your full retirement age. You get a permanent increase if you claim later than your full retirement age, up to age 70.
Yeah.
There are certain cases where if you claimed early and you kept working above the earnings limit, you just bank those benefits that would have been paid out for a future year when you stop making above that limit.
Oh, okay.
So you can kind of give yourself a short-term raise when you start getting those benefits.
Gamifying the system.
Yeah, sometimes there's benefits there. A lot of times there's not, but that is something you can do as well. But along with that, you know, we talked about before is it's not just about getting the retirement benefit for yourself.
Okay.
There's other benefits like your family can receive. So there's things called spousal benefits. There's benefits for your children. They come into play as it relates to the retirement benefits. One of the things that I want to make sure we talk about here that a lot of people are not aware of, or that questions come up for me a lot of times with married couples or even divorced couples, is if, like, let's say, just use us as a case study.
Sure.
So, like, right now, based on our business and our income, the revenue comes through my Social Security number, based on our business, right?
Correct.
So you are not currently logging earnings that go to pay into the system.
Right. What you're saying, what you're telling the world is that I don't pull a paycheck.
You do a lot more work than I do on a daily
That's
basis.
darn right.
Clarify
I have a 10-month-old. Of course I do.
You do a heck of a lot more work.
Yes, exactly. All the money comes in on yours. Yes.
So what that means is, like, in terms of the money getting paid in for that 35 highest years of earnings, you're not logging that. You're logging zeros today.
Yeah.
And I'm logging
it's not
numbers,
looking good for me.
But that's okay. and we see this with a lot of families where, you know, there's a stay-at-home spouse, or there's a spouse that makes a lot more and a spouse that made a little bit doing part-time work over time, right? A common misconception is that that person who didn't work as much or doesn't have as much benefit or didn't contribute as much income-wise won't have a benefit.
And that's not true.
It's not true, right? So
I knew that one.
So the spousal benefit program is where even if you don't claim a benefit by yourself, like if you don't have the 40 credits we talked about before, or if your benefit is extremely low, you can qualify for up to half of your spouse's benefit when you file.
Okay, let me ask another question.
Go for it.
Let's say their spouses, right, both did work. They both are claiming a benefit.
Yeah.
Let's say, for this argument, the man's benefit's a little bit higher than the woman's benefit. Is it possible for the man's 50% of the man's benefit to be higher than the full benefit of the woman, and then upon his death, the wife take over his benefit instead of what she was receiving?
Yes. Yeah, so that's a survivor benefit provision.
I hope people were able to follow that.
Yeah, so what you're saying is let's just use some rough numbers, right? So let's say husband and wife, husband's benefit is $3,000 a month.
Sure.
The wife's benefit is $2,400 a month. So they're combined bringing in $5,400 a month from Social Security because they both had a good career where they paid in and they have benefits that make sense for them to get their own personal benefit.
Right.
Key clarification there is, let's say the wife did not have as much work and her benefit on her own work history would be like $800.
Sure.
Which is less than half of what his benefit
would
is.
Be, yeah.
She could have a benefit of $1,500 because it's $800 plus a spousal add-on to get up to as much as half of his, right?
Interesting.
Right. So that's a spousal like add-on feature.
Okay,
where
cool.
Even if you don't have a lot of work history, you can still claim up to half of your spouse's benefit.
Cool.
The case on top of the spouse's benefits. Like he's getting his $3,000, she's getting $800, but also $700 add-on, so they're getting $4,500 total.
Understood.
But going back to your question around like someone passing away, is whoever has the higher benefit, let's say that person passes away, the surviving spouse can claim their benefit in lieu of what they were receiving themselves.
Okay.
So for either of those cases, like $3,000 for him and $2,400 for her, he passes away, she now gets $3,000 as his benefit. Another scenario, $3,000 for him, $1,500 for her. He passes away, she gets $3,000. Vice versa, she passes away. Either scenario, he keeps his $3,000.
Okay, I'm
going
lost.
forward.
But it's good to know there's options.
Yeah. Okay. The gist is,
I need a whiteboard.
The gist is, when we can do that, we can do a whiteboard. When the spouse passes away, the higher benefit remains with the family.
Understood. That's good to know.
Yeah. But that brings up another question around like children's benefits. So if you are eligible.
I haven't even thought about children being affected by this.
Yeah. And we work with, a handful of widows and widowers where this has come into play.
Okay.
Where let's talk about like with the actual person who qualifies for benefits living versus passed away. So if you're living and you qualify for benefits, say you had children later in life, or you have another marriage where you had children later in life, right? And say you're 65 years old and you're eligible to claim benefits. Well, you can actually have benefits claimed for your children as well, based off of your work history, up until they're age 18, or if they're 18 or 19 still enrolled in full-time school,
Do you have to opt into this, or are your children just automatically going to receive a benefit because
You have to file for it. Yeah. Which goes back again to why we're doing this, of making sure people know about what's available to them.
file before you pass, or can someone?
This is talking about if they're still living.
Okay,
Yeah.
got it. Kind of.
So let's say I'm 65 years old and I'm
I
receiving a
love
benefit.
real life examples.
Yeah. So I'm 65 and I'm bringing in a benefit of
You
$2,500
look good for
a month.
65.
Thank you. I've been
welcome.
working out. CrossFit for 3 years. It's great.
CrossFit SBL.
And nutrition. God, we're so stupid.
It's okay.
So the gist is, let's say I'm bringing in $2,500 a month and I still have children who are under age 18.
Okay.
I can file for them to receive a benefit as well, to come in on a monthly basis until they reach age 18, or if they're still 19 and enrolled in full-time school, they get the benefit until then. But if they're disabled, they can receive that benefit potentially for life. And I've actually got that as a note down here. So if you're 18 or older and you were disabled before age 22, you can receive that benefit ongoing.
Okay.
Now, however, let's say that I'm not 65 and receiving benefits, but I'm 47 and I pass away. Based on my earnings history, my family, my children can receive a benefit until they reach those same thresholds of 18 or 19 still enrolled in school, or if they're disabled before
It'll
age
just be
22.
a lesser.
It'll potentially be a lesser amount. Correct. So we have several families we've worked with where that was the case, where until the kids reached that certain age threshold, there was supplemental income coming in to replace what was lost when the primary breadwinner or the other spouse that was working passed away.
Hey, that's a great benefit, but it's also great to have life insurance
Yes.
because it's probably going to be a good bit more
Yes.
if you have private life insurance.
And I was talking with a good friend who's an advisor up in Tennessee last night, actually, about a case for one of his clients. Social Security is not a life insurance plan. Social Security does pay out a $255 death benefit if you pass away and you claim that.
$255.
$255. I don't know why it's that exact, but that is the number.
That might buy some flowers.
They marked that stuff up. That couldn't buy flowers.
Yeah, that's
Come
true.
on. But yeah, so $255 is your life insurance benefit from Social Security Administration. That is not a good plan. In the same way that Social Security is not a good retirement plan, it's not a good
Why
disability
even
plan.
pay it out? Oh,
I don't know.
That's weird.
This is one of those don't ask why questions. But
Yeah.
but in gist, it's one of those things where it's good that the benefit is there. It's accessible, right? But it shouldn't be the end all be all. Low cost term life insurance, or if you can't qualify for that, getting another kind of plan in place is definitely the preferred solution.
Okay, let me ask you some questions because this affects me.
It does.
I have a 10-month-old at home. You are, by far, our primary breadwinner. Something happens to you. Would you have had to actively select for Samuel to receive benefits, or is that something that a spouse can do after the fact?
Spouse does it after the fact.
So like mom,
Correct.
aka me, could do that with the administration office
Yeah.
on behalf of Samuel
Correct.
until he's 18.
Correct.
Okay. That's a real life example.
Yeah.
The more you know. I learn stuff every day.
And this is good for us to talk about, right?
Yeah.
Because we've also had clients that have passed away in their mid-20s, and
Of course, and they
all
have young
ages,
children
and they
at
have
home.
young kids, and it's a thing. It's a fact of life, right? But
Yeah.
it
There's a
all
lot of
goes back
specifics
to-
around that.
Yeah, and it all goes back to being prepared, and it all goes back to being intentional and not just assuming that things are going to work out, right? Because in that case, right, like let's say I did pass away. Yes, there's plenty of life insurance in place. Yes, there's a business continuity and succession plan in
Right.
place. Yes, if I'm disabled, there's disability insurance in place. Like all those things are in play, right? But in the midst of your grieving, you shouldn't be having to figure this out, right? You should not be having to wonder what's going to happen with a house if your spouse passes away. Like, let's have a plan in place for that.
Yeah.
With the Social Security stuff, like the funeral home will most likely, communicate with Social Security to let them know you passed away. They'll provide the death cert, those kind of things. But maybe not. Maybe something gets missed. So let's have a plan in place to know what the rules are, what the potential benefits are that we can pull from to be strategic and intentional when things happen.
Is there a specific equation that a child's benefit is calculated off of? Like there has been for like all the other, like the spouse is very specific. It's 50%. Is there something like that for the children?
Yeah, so there are some different criteria. It all goes back though to, and same with like divorced spouses and things like that. It all goes back to how much your earnings record is.
Okay.
Which goes back to what we said before on a prior episode, is increasing your income is of exponential importance, and making sure if you see this as part of your plan, paying in the right way helps, right? So like if you are a business owner, having earnings that are calculated as qualified compensation, not just taking distributions as an S corp, or not just taking partnership passive distributions or just real estate income. Like if you only have that,
that's why it would also be important to have a really great tax person.
Correct.
And most likely not you on TurboTax.
Correct.
Yeah.
And like I've said before, don't use TurboTax.
Right.
Their entire corporate mission is to get people into debt.
Yeah.
It's in the records. Go look it up.
Interesting.
That's why they bought MailChimp and Credit Karma and all that. But anyway, so in the gist, they're like, yeah, the point is like the more you can increase your income, not saying, again, this is a retirement plan or a disability plan or life insurance plan. It's not. But doing this right can make sure that you have the best benefits for your life.
How you hack it.
How you hack it, right?
Yeah.
Don't be a hack it, right? But there's a lot of things to consider here that we need to be proactive about. And we can't obviously talk about every case study here or scenario.
No, and I see on your list here, there's so many different specifics about what qualifies a child, and we don't need to worry about that.
Yeah. If there's specific questions, we can handle those one-off.
Of course.
But the key thing is making sure you understand, I'd say high level for this series is there's 4 benefits from Social Security. It's retirement, disability, survivor, and supplemental security income.
Yeah.
Plus you use them to file for Medicare.
Right.
That's the key thing. Around your Social Security benefits, you can file as early as 62 or you can defer until age 70. You have a permanent reduction or a permanent increase on your benefits based on that. The number one factor for how much you'll receive down the road under the current system, the way it's designed, is how much money you make each year and how you pay into it.
Got it.
If you have fewer than 35 years of qualified earnings, your benefit's going to be lower, right? Because it's all based on that 35-year average. Okay. You're adding in zeros. That reduces it. If you have more than 35 years of qualified earnings, you're increasing your chance of getting a better benefit because your lower years will be dropped off that calculation and your higher years will be added into it.
Okay.
It's because it's all your highest 35 years is what goes into it. But timing the decision around when to claim is very personal. So any Motley Fool article or Smart Asset article or Investopedia article you read out there or news headline or dinner seminar or steak advertisement you receive in the mail that talks about the best way to do it. The best way to do it is the one that works best for your financial plan, right? It is so personal. It's so individualized that we can't just say there's one way to do it for every single person out there.
Yeah. Well, that's a good point to make for sure.
Yeah. But just like with anything financial, it's understand where you are today, have a clear vision of where you want to go, and then let's map that out with a competent professional to be successful over time.
Right.
So
perfect. Well, thanks so much for hanging out with me and handling my questions today.
Yeah, you've been hard today. So.
No, I don't mean to be.
But just in closing, we're definitely trying to create helpful content that maybe evokes more questions that need to be asked, right? And be a resource for folks that have questions to provide the answers that people need for their own personal journey. So we would love your feedback. Please feel free to share reviews with us. Reach out to us with any topics or ideas we can work on in the future.
Yeah.
And until next time, have a good one.
Great. Thanks, guys.
Thanks. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.